CEOs are panicking as high prices and declining demand point to a recession. I'm your host, Steven Van Metre, and thanks for joining me today. And while investors are betting big on a bear market rally that could take stocks to new all-time highs, CEOs are starting to warn that perhaps things are going to get much worse, and that could bring stock prices much lower. Let's kick this story off with the headline that most CEOs are bracing for a recession. And CEO confidence has tumbled to the weakest level since the beginning of COVID-19 pandemic, according to a recent Conference Board survey. For the first time in the economic expansion, CEO confidence is now in negative territory. Worse, business leaders are bracing for a potential downturn caused by the Federal Reserve's quest to tame inflation. A staggering 68% of CEOs surveyed by the Conference Board expect the Fed's war on inflation will eventually trigger a recession, and for good reason. The Fed has a very strong track record of tightening monetary policy until we get a recession. And as you remember from the recent FOMC press conference, Powell talked about former Fed Chair Paul Volcker, who triggered 2 recessions to bring inflation down, and said that may be the path that we're headed on. The survey field between April 25th and May 9th measured responses from 133 CEOs of mostly public companies. The good news is that a mere 11% of CEOs anticipate a so-called hard landing marked by a deep recession. The rest expect a very short, mild recession. Importantly, business leaders are not only necessarily preparing for an imminent recession, or not necessarily preparing for an imminent recession. The survey did not specify when the downturn would begin, merely describing it as over the next few years. And this is kind of the story we're seeing now is, well, everyone agrees there's going to be a recession, but they believe it's not going to be very much. It's going to be very mild. They're hoping it's going to be a soft landing. And why is that? Well, as we get into the real underlying reasons of what's going on to corporate America in today's show, you're going to see why that the panic that you're starting to see from the CEOs is going to get much worse. Walmart is not alone. Nearly 61% of CEOs surveyed by the Conference Board reported that economic conditions have worsened over the past 6 months, compared with 35% that said during the first quarter. Just 14% of CEOs reported improving economic conditions. Recession fears have been driven large part by high inflation, and for good reason, because when you look back historically, you can see the periods of rising inflation, as shown here by the year-over-year rate of change in the consumer price index, are followed by these gray shaded areas, which are recessions. And so it's only likely that this high move in inflation is going to be followed by a recession, because one way you get demand down, well, is to cause a recession, and that usually brings inflation and prices much lower with it. And that seems to be the Fed's recipe for success right now. And you can always talk yourself into recession. If businesses start shedding jobs in anticipation of a recession, well, that's going to spook consumers, and that can get us into a recession. And this is one of those talking head responses that makes absolutely no sense. I've never worked for a company where the head of it said, hey, I think a recession's coming perhaps in the months or years to come, and so I'm going to start laying off people now. That never happens. Employers are looking at demand. If they have demand coming in, they need people, workers to produce, and so they hire and they maintain staffing levels. It's not until after demand starts to fall off and the workload starts to disappear that they then start shedding jobs. They don't do this in advance, but then again, people perhaps that are making these comments just don't get it. Let's continue on, because U.S. corporate profits fall while consumer spending is rised up. So now we're perhaps starting to see some of the reason these CEOs are starting to worry, as pre-tax profits declined 2.3% in the first quarter as the economy shrank at 1.5%. After-tax profits as a share of gross value added for non-financial corporations, a measure of aggregate profit margins, improved to 14% in the first quarter from 13.8% in the previous 3-month period. That marked the 4th straight quarter in which margins were wider than any other period in 1950. And one of the notable things about high profit margins is, well, in this chart provided by Bloomberg from the U.S. Department of Commerce, is you'll notice periods of high profit margins are generally followed by these red bars, which are recessions, or you see rapidly declining profit margins. And that indeed is a concern, because here we are now with profit margins very high, and the likely direction now is for them to head even lower. And the reason we're going to see them head lower has to do with inventory levels. So what the story becomes is a story of declining demand and high supply. Now remember, we've been told the supply is really low. We're very short goods and services. We don't have enough. We need more of them because demand's too much. But perhaps the real story is demand is falling as supply is shooting higher. Let's head back to this headline from Bloomberg. As inventory levels seem ballooning as companies turn cautious, firms will shift from just in time to just in case, as inland logistics are another pain point in China and the U.S., as moving goods between the countries is difficult. And companies from retailers to manufacturers will hold greater levels of inventory this summer as global supply chain snarl forces a shift from just-in-time mentality to just in case. And if you're a retail business, what's more expensive, to carry some additional inventory or miss out on sales completely? Now remember the story before the pandemic. What was it? It was you need inventory. And then after the pandemic, because of all the demand, you need inventory. You need it at any price because people can afford it. Now it's like, well, hey, it's okay if you have some extra inventory because somebody might walk in your business here in a couple of weeks, and if you don't have it, they can't buy it. And that's a big shift from where this was when we heard that there was this unprecedented amount of demand, and we're seeing more and more signs as demand's falling that will bring profit margins down and ultimately lead us to a recession led by the Fed. Now, if there's one thing that shouldn't be tumbling down as we head into recession, that's your portfolio. I'll put a link up here to Portfolio Shield and a link in the description below. You should check it out. You'll be glad you did. All right, let's continue on with the story, because where do we go next is what do businesses do when things start to get bad? What's the first step they will do? Well, they'll cut job openings, right? Now think about it. If an employer needs employees to produce goods and services, they hire people, but as demand slows down, what do? Well, they'll scale back those openings, and we're starting to get some early signs that that's happening. The job openings and labor turnover survey plunged by the most since COVID crashed, but remains stubbornly elevated with quits near record highs. Of course, as we've looked in the past, that has much to do with the stock market. And we had predicted that perhaps we would see a more decline in job openings, but that didn't happen. Instead, the 2-month delayed JOLTS report showed that in April, job openings did plunge by a whopping 455,000, the biggest 1-month drop since the COVID crash. But the drop was from an upward revised and even higher record, 11.855 million in March to 11.4 million, the third highest on record. And what is remarkable is that despite one of the biggest drop in job openings on records, the continued tightening in the labor market, where there's a whopping 5.4 million more vacant jobs than unemployed workers in April, nearly double the 5.9 million total unemployed workers, confirming that the U.S. labor market remains extremely tight. Of course, there's one way to fix, a tight labor market, and that's to bring the stock market down. And when you see this chart, it starts to make perfect sense, because there is a very strong relationship between the stock market and job openings. Check this out as we look at the JOLTS job openings total non-farm in blue against the Wilshire 5000, the total U.S. stock market in red. And what you'll note is that as the stock market starts to come down, and this is not on a year-over-year rate of change, this is just the index, notice how job openings peak and come down. And you can see, of course, as the market slows down, job openings comes down, and now the market's coming down, and that is an indication that job openings are going to come down too. Now, I want you to think of, why does that happen? What is the relationship there? And it's everything to do with the wealth effect. Because when people have less wealth, or they feel less wealthy, they tend to spend less, and that's why the U.S. economy is more about the U.S. stock market than anything else. But what's the next step we see employers do when they cut job openings? Well, they start to cut employees. And where do they cut them from first? Yeah, you're right. The smallest employers. Check this out as we see the ADP employment report from May came with 128,000 increase in jobs after a downwardly revised last month, missing expectations. But look at this, 91,000 job losses in small businesses. Make it even worse, it's coming from very small employers with 1 to 19 employees, dropping 78,000, and you can see the goods producing sector decline. But how about the services sector? Now, we've heard there's this huge demand for services, and yet you're seeing small employers and very small employers dropping, of course, workers. And when we see layoffs start to begin, where do they start? Well, they start with the smallest employers first, and then they move to the mid-size and then the big companies. But we're also seeing some other indications that perhaps why CEOs are panicking, and that has to do with the labor market data. As we see, we got the preliminary non-farm productivity and the unit labor cost for the first quarter, with non-farm productivity dropping minus 7.3% as unit labor costs continue higher at 12.6. Now, here's the non-farm business sector labor productivity. This is output per hour. Now, if you're not sure what this means, this is what an employer gets in terms of output per hour for an employee. Now, if you're hiring a lot of new people, well, they don't know how to do the job, and they're not going to be very efficient. It takes time to learn a job, and even if you're skilled in your job and you go to a new employer, you still have to learn the ropes of the new employer, get into their system to be more productive. Now, what's notable here is we're seeing a negative non-farm productivity, suggesting that people just aren't very productive at all. And what is notable is we look back, and here we see where we are now is periods where this is negative or trending very low. You have slowdowns in the economy like we saw in 2015, 2016, or you see declines leading into a recession. Here you can see that going into the great financial crisis. The dot-com bubble saw a decline. Of course, we saw previous recessions show a decline, and now we're showing a decline, suggesting that we're headed into recession. But where you get inflation from is non-farm business sector unit labor costs, because what's happening here is employers are paying big money for unproductive employees. And I want you to understand how this switch happens, because you come on, you get a nice salary, maybe a bonus, because employers are desperate. You're not very productive, but what happens over time? Your productivity goes up. And what happens to those pay increases? They go down. And that's why you see a switch in these two, because right now we see unit labor costs are very high as employers are paying big money, and that has a big link to inflation, perhaps more than anything else. And here you can see unit labor costs in blue against the consumer price index, which is on a year-over-year rate of change, and you can see these real high points in unit labor costs generally precede recession, as do, of course, the CPI. But what starts to peak and go down usually now is unit labor costs, as wages do not keep up with inflation. And that was a story going back to the beginning of today's show, when employers, our CEOs, mentioned that high consumer prices lead to a recession. Why is that? Because wages don't keep up with them. And that's the key, is if employees cannot and people cannot afford higher prices, they get rejected. And then all of a sudden inventory levels build, profit margins go down, and then next thing you know, job openings decrease, layoffs start to increase, and we're not quite there yet, because we got the weekly unemployment data today. Initial claims still at very low levels, down 11,000 from last week to 200,000 initial claims, and total claims sitting at 1.3 million. So we're seeing very low claims, but we're at the early stages, because when the CEOs start to panic, well, you know, they're on the top. They see all the data. You know what's coming next, and that's a recession. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.